Banks make $200 billion in profit every year. Credit card companies make another $180 billion. Where does that money come from? From people who were never taught how these systems actually work. Today that changes. Welcome back to Wealth Can Do. This is part 2 of our financial literacy series, What School Never Taught You About Money. In part 1, we covered the foundation: money, income, and expenses. If you haven't watched part 1, go back and watch it first. This series builds on itself. Today we're diving into banking, credit, and debt. By the end of this video, you'll understand how banks really make money, why your credit score matters more than you think, the difference between good debt and bad debt, and how to use the system instead of being used by it. School never taught you this because banks profit from your ignorance. Let's change that. Let's get into it. Let's start with the fundamental question: how do banks make money? Most people think banks store your money in a vault and pay you interest out of kindness. Wrong. Banks use your money to make themselves wealthy, and they pay you pennies in return. Here's how it actually works. You deposit $10,000 in a savings account. The bank pays you 0.5% interest. That's $50 per year. The bank then loans you $10,000 to someone else at 7% interest. That's $700 per year. The bank keeps the $650 difference. That's their profit. They're using your money to make money and giving you scraps. Banks make money 3 ways. Way 1. Interest rate spread. This is what I just explained. Borrow low from depositors, lend high to borrowers. The spread is pure profit. Way 2. Fees. Overdraft fees, ATM fees, monthly account fees, wire transfer fees, insufficient funds fees. The average American pays $329 per year in bank fees. Multiply that by millions of customers. That's billions in profit. Way 3. Investments. Banks invest your deposits in stocks, bonds, and other assets. They keep all the gains. You get your 0.5% interest, regardless of how well their investments perform. Here's what school never taught you. You're not a customer to the bank. You're the product. The bank needs your deposits to make loans. They need your fees to boost profits. They need your lack of knowledge to keep margins high. This is why financial literacy isn't taught in schools. Educated customers demand better rates, avoid fees, and shop around for better deals. Banks make less money from educated customers. So what do you do with this knowledge? 3 things. 1. Use high-yield savings accounts, paying 4 to 5%, not big bank accounts, paying 0.5%. 2. Never pay fees, choose fee-free banks, and avoid overdrafts. 3. Understand that banks work for their shareholders, not for you. This mindset shift changes everything. Your credit score is a 3-digit number between 300 and 850 that determines how much you will pay for debt for the rest of your life. A person with a 760 credit score gets a $300,000 mortgage at 6% interest. Over 30 years, they pay $347,000 in interest. A person with a 620 credit score gets the same mortgage at 8% interest. Over 30 years, they pay $491,000 in interest. Same house. $144,000 more in interest. Just because of a credit score. School never taught you this. But this 3-digit number can cost you hundreds of thousands of dollars over your lifetime. Your credit score is calculated from 5 factors. Factor 1. Payment history contributes 35%. Do you pay bills on time? This is the biggest factor. One 30-day late payment can drop your score 100 points. Factor 2. Credit utilization contributes 30%. How much of your available credit are you using? If you have a $10,000 credit limit and you're using $9,000, that's 90% utilization. Terrible for your score. Keep it under 30%, ideally under 10%. Factor 3. Length of credit history contributes 15%. How long have you had credit? The longer the better. This is why you should never close your oldest credit card. It shortens your average account age. Factor 4. Credit mix contributes 10%. Do you have different types of credit? Credit cards, auto loan, mortgage, etc. Variety helps your score. Factor 5. New credit contributes 10%. How many new accounts have you opened recently? Opening too many accounts too fast hurts your score. Here's what wealthy people know about credit scores that school never taught you. Your credit score isn't about being responsible. It's about gaming a system. You can have perfect financial habits and a bad credit score if you don't understand the rules. Use the following strategy. 1. Pay every bill on time, every time. Set up autopay. 2. Keep credit utilization under 10%. Pay off cards weekly if needed. 3. Keep old credit cards open forever, even if you don't use them. 4. Have a mix of credit types, credit card, car loan, etc. 5. Don't apply for new credit unless you need it. Follow these rules and you'll have a 750 score. That score saves you hundreds of thousands over a lifetime. School never taught you this. Banks don't want you to know this. But now you do. School taught you that all debt is bad. Get out of debt. Be debt-free. That's incomplete advice. So there are two types of debt: good debt and bad debt. Wealthy people use good debt to build wealth. Poor people use bad debt and stay poor. The difference? Good debt makes you money. Bad debt costs you money. Let me explain. Bad debt is anything that loses value or doesn't produce income. Credit card debt. Average interest rate is 24%. You're paying $240 per year for every $1,000 you owe. That money is gone forever. You're working to pay interest, not building wealth. Car loans. A new car loses 20% of value the moment you drive it off the lot. You're paying interest on something that's losing value. That's bad debt. Personal loans for consumption. Borrowed money for vacations, weddings, furniture, electronics, things that don't produce income or appreciate in value. You're paying interest on depreciating assets or experiences that are already over. Payday loans. 400% APR. This is predatory. If you're using payday loans, you're trapped in a cycle that's mathematically impossible to escape without drastic changes. Here is the rule. If the debt is for consumption or depreciating assets, it's bad debt. Avoid it. Good debt is anything that produces income or appreciates in value. Mortgage on rental property. You borrow $200,000 at 7% interest to buy a rental property. The property generates $2,000 per month in rent. After paying the mortgage, taxes, and expenses, you cash flow $500 per month. The debt is paying for itself and generating profit. Plus, the property appreciates over time. That's good debt. Business loans. You borrow $50,000 at 8% to expand your business. The expansion generates $10,000 per month in additional profit. The debt pays for itself in 5 months. Then it's pure profit. That's good debt. Student loans. Sometimes. If you're borrowing $30,000 to become a doctor who will earn $300,000 per year, that's good debt. If you're borrowing $100,000 for a degree with no job prospects, that's bad debt. Student loans can be either. It depends on the return on investment. Mortgages on primary residence. Debatable. This one is a gray area. Your home can appreciate, but it doesn't produce income. I'd call it neutral debt. Not as good as rental property debt. Not as bad as credit card debt. Here's the rule wealthy people follow. If the debt produces income or appreciates faster than the interest rate, it's good debt. If not, it's bad debt. For example, a rental property appreciating 5% per year, plus cash flowing $500 per month, while you're paying 7%. Interest might still be good debt because of the monthly cash flow and long-term appreciation. But a $50,000 car loan at 6% on a car that's losing 15% value per year? That's terrible debt. School never taught you to think about debt this way. They taught you all debt is bad. But wealthy people use good debt as leverage to build wealth faster. The key is knowing the difference. If you're in bad debt right now, here's the hard truth. You cannot invest your way out of high-interest debt. If you owe $10,000 on a credit card at 24% interest, and you're trying to invest your way to wealth, you're fighting a losing battle. You can't reliably get 24% returns on investments. Pay off the debt first. This is the debt avalanche versus debt snowball debate. Here's what actually works. Step 1. Stop accumulating new debt. Cut up the cards. Delete the apps. Stop borrowing. You can't dig out of a hole if you're still digging. Step 2. Build a $1,000 emergency buffer. This prevents new debt when emergencies happen. Small buffer, but it breaks the cycle. Step 3. Attack the debt. 2 methods. 1. Debt avalanche. Pay off highest interest rate first. Mathematically optimal. Saves the most money. 2. Debt snowball. Pay off smallest balance first. Psychologically motivating. Creates quick wins. I recommend Avalanche for disciplined people and Snowball for people who need motivation. Step 4. Never go back. Once you're out, never use bad debt again. Credit cards are fine if you pay them off monthly. Car loans are fine if you buy used and keep the term short. But never carry consumer debt at high interest rates again. If you have $20,000 in credit card debt at 24% APR and you pay $1,000 per month, you'll be debt-free in 24 months. You'll pay $4,140 in interest. Alternatively, if you only pay minimums 2% or $400 per month, whichever is higher, you'll be in debt for 9+ years. You'll pay $26,000 plus in interest. This is why minimum payments are a trap. Pay aggressively. Get out fast. Never go back. Once you're out of bad debt and you understand how credit works, you can use it strategically. Here's how wealthy people use credit cards. Strategy 1. Rewards and cash back. Pay for everything with a rewards credit card. Earn 2 to 5% cash back. Pay off the balance in full every month. Never pay interest. Free money. If you spend $3,000 per month on a 2% cashback card, that's $720 per year free. Over 30 years invested at 10%, that's $130,000. Just from using credit strategically. Strategy 2. Building business credit. Wealthy people separate personal and business credit. They use business credit cards for business expenses, get rewards, and build business credit for future loans. Personal and business credit don't affect each other. Strategy 3. 0% balance transfers. Some people use 0% balance transfer offers to borrow money interest-free for 12 to 18 months. Invest it and pay it back before interest kicks in. This is advanced and risky. Don't try it unless you're extremely disciplined. The rule with credit: never pay interest. Ever. If you can't pay it off in full, you can't afford it. Credit cards aren't for buying things you can't afford. They're for convenience, rewards, and building credit history while buying things you were going to buy anyway. Use credit as a tool, not a crutch. This is what school never taught you. Let's recap Part 2. Banking, Credit, and Debt. Lesson 1. Banks make money from interest spreads, fees, and investments using your deposits. You're the product, not the customer. Lesson 2. Your credit score costs or saves you hundreds of thousands over a lifetime. Game the system. Pay on time, keep utilization low, maintain old accounts. Lesson 3. Good debt produces income or appreciates. Bad debt is consumption. Wealthy people use good debt as leverage. Lesson 4. Get out of bad debt fast, using Avalanche or Snowball method. Never carry high-interest consumer debt. Lesson 5. Use credit strategically for rewards and credit building, but never pay interest. These 5 lessons will save you tens of thousands of dollars over your lifetime. School never taught you this. Banks hoped you'd never learn it, but now you know. In Part 3, we're covering investing and building wealth. You'll learn the difference between saving and investing, index funds versus individual stocks, the power of compound growth, how to start investing with just $100, building $1 million portfolio on an average salary. If this video taught you something valuable, hit that like button. It helps us reach more people who need this education. Subscribe to Wealth Can Do and turn on notifications for Part 3. We're building a complete financial education here. Share this with someone drowning in credit card debt or someone who doesn't understand how banks work. Financial literacy changes lives. Drop a comment. What's your credit score goal? Where are you now, and where do you want to be? Let's track progress together. Remember, the system is designed to keep you ignorant. But knowledge is power, and you're now more powerful than you were 10 minutes ago. See you in Part 3.